Hello, my name is Shaun Sweeney, and I'm an investment advisor representative and retirement income certified professional with Cetera Investors. And today, we are going to be discussing traditional IRAs and Roth IRAs. A traditional IRA, or individual retirement account, is a personal retirement account that offers certain tax benefits. Contributions may be tax deductible, and while your money is inside of the IRA, it grows tax deferred. Ultimately, when you take money out of your IRA, the amount that you take out is generally added to your income. In 2020, the maximum you can contribute to a traditional IRA is $6,000. If you're 50 years old or older by the end of the year though, then you're allowed to make an additional $1,000 catch-up contribution, making the maximum you can contribute to an IRA for 2020 $7,000. You cannot always make a traditional IRA contribution though. For instance, to make a traditional IRA contribution, you must have what the tax code refers to as compensation. For most people, compensation is just earned income, but it also includes a number of other types of income, such as taxable alimony. It does not, however, include things like interest, dividends, capital gains, Social Security benefits, or unemployment compensation. So most of the time, if neither you or your spouse work, you will not be able to make a traditional IRA contribution. The only other reason you could be prevented from making a traditional IRA contribution is your age. Once you reach the year that you turn 70 and a half, you can no longer make a traditional IRA contribution. Now, many of you probably know that there's another type of IRA called a Roth IRA. Roth IRAs are similar to traditional IRAs in many ways, but there are also some key differences. One of those differences is that you do not get a tax deduction when you make a Roth IRA contribution. Once your money is in the Roth IRA, it grows tax deferred, just like it does with the traditional IRA. The big benefit of the Roth IRA though, and another key difference between it and the traditional IRA, is that Roth IRA distributions can be tax-free in retirement. If you've had any Roth IRA for more than 5 years and you're over 59 and a half, then all withdrawals from any of your Roth IRAs will be tax and penalty-free as part of what's called a qualified distribution. Even if you need to take a withdrawal sooner, you can always take out your Roth IRA contributions tax and penalty-free. Some of the same contribution rules that apply to traditional IRA contributions also apply to Roth IRA contributions, namely the same maximum contribution limits and the same compensation rules. But there are some differences. If you have sufficient compensation, then the only thing that could prevent you from making a Roth IRA contribution is having too much income. For example, if you are married filing jointly and have income that's exceeding $206,000 in the year 2020, the income limit would make you ineligible to make Roth IRA contributions. I hope that this video was a helpful place to start, but I will be getting a lot more in depth in the upcoming IRA online workshops that I host live on a regular basis. So if you have questions about which type of IRA might be the right one for you, yes, I will be discussing that. Just click the link below to see the full schedule of my upcoming workshops on this and other important topics. But if you have more specific questions related to your own personal situation, I'm happy to schedule a one-on-one consultation. The first one is free, but out of respect for my current clients who pay me, I will only be doing one free consultation per household. Thank you, and see you next time.